The closing bell rang, what, about 15 minutes ago?
Yeah, it's about 15 minutes.
Right. And I mean, the closing prints on the tape today are just absolutely staggering. Based on that massive stack of institutional reports you sent over for us to review, today, Monday, June 15, 2026, is officially a historic face-ripping blowout.
Oh, without a doubt.
Let's get straight to the scoreboard because we have to look at these numbers. The DIA jumped 1.21%, closing at a fresh record of 51,819.57. SPX surged 1.78% to hit 7,564.000.
Massive move.
And the NDX, I mean, it spearheaded the entire charge, rocketing up 3.02% to end the session at 26,631.40.
Right.
You look at the screen and it is just drenched in green.
Yeah, it looks like euphoria. But, the real narrative today isn't about the points we gained.
Right.
It's about what the biggest, smartest investors on Wall Street were quietly doing under the surface, while retail was out there celebrating a breakout.
Because when you actually tear through the order flow data from today's session, you realize pretty quickly this is not some structural high-conviction breakout.
No, not at all. We are looking at a classic headline-driven head fake. I mean, that entire rally in the Dow, it was built on a severe lack of volume.
Almost non-existent.
Exactly.
Yeah.
It was a low-liquidity environment that was basically masking this incredibly violent short-covering squeeze. And that was driven entirely by the macro news over the weekend.
Okay, let's unpack this.
Yeah.
Because we really have to start with that macro catalyst. It completely rewired the risk models before the opening bell even rang.
Yeah, flip the board.
Over the weekend, the U.S. and Iran announced a tentative peace framework. They're halting the conflict and officially reopening the Strait of Hormuz by Friday. So that naval blockade gets lifted.
Which is huge.
It's like taking a whistling pressure cooker right off the stove. That geopolitical premium that had been choking global supply chains just evaporated overnight.
And you saw it immediately in the energy markets. I mean, crude oil plunges 5% with WTI dropping down to the $80.20 handle.
Which is wild.
Yeah. And the immediate reflex in the options market was just a total volatility crash.
Yeah.
The VIX collapsed from last week's 23 handle all the way down to 16.13.
And that drop in the VIX, that is the mechanical engine behind the morning gap up, right?
Exactly. When you see implied volatility bleed out that fast over a weekend, you aren't just seeing psychological relief. You are watching systematic volatility targeting funds being mathematically forced into the market.
Because their algorithms demand it.
Right. Those systematic funds, they size their equity exposure inversely to the VIX. So when volatility drops 30%, their risk models dictate they have to buy billions of dollars of S&P futures at the open just to maintain their target risk allocations.
So it's blind mechanical buying.
100%.
So it's not a fundamental judgment on corporate earnings or anything. It's just an algorithm re-leveraging because the math says it's safe to swim again.
Yeah, they're just following the code.
But when we look at the internal engine of the market today, that systematic buying clearly wasn't matched by discretionary institutional capital. I mean, look at the SPX daily trading volume. It printed at roughly 845 million shares.
Which is weak.
Yeah, the 30-day average is over 968 million. So we are looking at a massive upside move on incredibly thin volume. And my question to you is, if the peace dividend is universally fantastic news, why did the real money sit on its hands today?
Well, what's fascinating here is that they sat on their hands because jumping into a gap up on thin volume is exactly how you get trapped.
Right.
The volume profile tells us exactly who was buying today. It was trapped shorts. I mean, imagine the macro hedge funds that came into the weekend heavily short the market, betting that energy prices were going to spiral out of control.
Derailing the global economy.
Exactly. Then this peace framework hits, and suddenly they are caught completely off sides. At 9:30 a.m., they're trapped in a burning building.
And buying back the underlying stock is the only exit door.
It's the only way out.
And because it's a panic bid environment, the market makers on the other side of those trades, they see the toxic urgent flow coming in. They aren't stupid.
No, they'd pull back.
Yeah, they widen out their spreads, they pull their offers. So when those massive short covering buy orders hit the tape, they hit thin air.
Right, which causes the price to naturally gap up aggressively because there's just no immediate liquidity to absorb the panic.
It's an air pocket.
Exactly, the mechanics at play. The price goes parabolic, not because new investors are allocating fresh capital, but because pessimistic money is bleeding out.
Forced buying.
Forced buying. And institutional order flow data you provide for this deep dive, it confirms this cynically. The deep-pocketed institutions, the smart money, did not deploy fresh structural capital today.
They were actually doing the opposite into the close.
Yes. As the indices ripped higher into the afternoon, the real money was actively fading the cyclical rally.
They were the ones providing the supply. I mean, if you look at the intraday chart, the Dow actually peaked midday near 51,922.
Right around there, yeah.
That's when the institutional iceberg orders hit the tape. They fed stock into the retail and short covering momentum, quietly de-risking and taking profits, which is exactly why the Dow bled out nearly 100 points into the closing print.
That's classic volume confirmation of a fade. But we also have to respect the breadth data here because it introduces a major contradiction to this whole bearish volume argument.
Okay, let's hear it.
Well, despite the big institutions stepping back, the market breadth was undeniably robust today. The NYSE advanced decline ratio closed at 1.8.
So almost 2 stocks went up for every one that declined.
Exactly.
Right, and if you look at the SPX components trading above their 50-day moving average, that jumped up to the 56% to 61% range today.
Which is a massive recovery from those mid-May lows when we were sitting under 45%.
Right, so if the big boys are just fading the rally and taking profits, why are we seeing the Russell 2000 breaking out to fresh all-time highs today? I mean, small caps don't surge like that if the entire market is just a fragile short squeeze.
And that's the nuance. The Russell breakout is the evidence of a massive, under-the-surface capital rotation.
A rotation.
Yes. So institutions were fading the mega-cap indices at the highs, sure, but they were simultaneously rotating cash out of defensive sectors and putting it to work in cyclical risk-on assets.
It's the good news is good news trade.
Exactly.
Yeah.
When WTI crude collapses to $80, that acts as a massive, immediate global tax cut for the everyday consumer, and it drastically lowers operating costs for transport and manufacturing.
But it's toxic for raw commodity producers.
Right, which is why the energy sector was the absolute bottom laggard today. But it is pure rocket fuel for the broader economy.
Which brings us to the great divergence. Energy gets crushed, but the technology sector rips over 3%. Money aggressively rotated right back into the mega-cap growth and semiconductor names.
Yeah, they piled back into tech.
But here's where it gets really interesting. Because this is where the fundamental math starts to look incredibly suspect. You have tech valuations absolutely soaring on the back of this geopolitical peace dividend, acting like cheaper oil solves all their problems.
Like they operate in a vacuum.
Right. But they are completely ignoring the macroeconomic reality check that is staring them right in the face.
You're talking about the bond market.
Exactly. The equity market is, popping champagne, but the bond market is essentially barricading the doors. Despite the SPX flirting with all-time highs today, the 10-year Treasury yield is persistently, stubbornly anchored right near 4.45%.
It refused to break down today.
It did. And that yield is the mechanical discount rate for every high-growth tech valuation in the market.
And this is the crux of the fragility in the Nasdaq right now. The multiple expansion we saw in tech today is mathematically tethered to the assumption that interest rates are coming down. Because high-growth tech stocks are essentially long-duration assets. Investors are paying a premium today for massive cash flows projected 5 to 10 years in the future.
So when the risk-free rate, the 10-year Treasury yield stays high,
the present value of those future cash flows gets mechanically crushed.
and the landlord is literally walking up the stairs to hike the rent. The Federal Reserve's FOMC meeting kicks off tomorrow, Tuesday.
Yes, it does.
And this is a monumentally important meeting because it is the debut of the new Fed chair, Kevin Warsh. And the market really doesn't fully know his baseline reaction function yet.
No, but the futures market is already placing its bets, and it is not dovish.
Not at all.
Fed funds futures are currently pricing in a greater than 50% chance of a rate hike, not a cut, before the end of 2026.
Wait, really? A hike?
Yes, the underlying inflation data has just been too sticky, specifically in services and housing.
So if you are out there buying a semiconductor stock at 45 times forward earnings today based on a short covering squeeze, you are stepping right in front of a freight train if Chair Warsh steps to the podium on Wednesday and delivers a hawkish, restrictive mandate.
You'll get run over.
If he signals higher for longer to combat that sticky inflation, the discount rate spikes, and this light volume tech rally faces an immediate violent valuation reset.
Which is exactly why the big institutions were de-risking and flattening their books this afternoon. I mean, they refused to hold massive directional exposure into a wildcard Fed press conference.
That institutional hesitation completely defined the micro-level battles today. And I want to look at specific tickers because the price action under the hood was incredibly violent.
Let's do it.
Let's start with the M&A space. Fox announced a massive $22 billion deal to acquire Roku for $160 a share in a mix of cash and stock.
Big deal.
Roku predictably rockets toward that deal price. But Fox craters so hard it becomes the SPX's worst performer of the day. And if you're just looking at the surface, you might assume, oh, the market hates Fox's balance sheet post-acquisition.
But the order flow tells a completely mechanical story. It's textbook merger arbitrage fallout.
Explain that for the active traders out there.
Sure. When a cash and stock acquisition is announced, multi-billion-dollar arbitrage funds immediately step in to lock in the spread between the current trading price and the final acquisition price.
Okay.
To do that risk-free, they aggressively short the acquiring company, which is Fox, and they buy the target company, Roku.
Ah.
So Fox didn't drop today because of a fundamental referendum on the company's future. It was physically forced down by algorithmic short selling to hedge those long Roku positions.
It's purely structural selling pressure.
Exactly.
And the playbook you outlined in the research suggests that creates a massive day two play for tomorrow. If the selling in Fox is purely mechanical arb flow, you wait for the early morning washout, right?
Yes. That's the setup. Once those arbitrage funds finish building their books, the selling pressure exhausts itself, leaving a liquidity vacuum.
Which opens the door for a mean reversion long trade once the panicked deal selling dries up.
That's the exact day two play. You fade the mechanical flow once it peaks.
Love that.
But, we saw a different kind of liquidity trap today in the AI hardware space. Look at Western Digital, ticker WDC.
Oh yeah, that was brutal.
It opened incredibly hot. It surged straight to an intraday all-time high of $658.80 right out of the gate. And that was fueled by retail momentum and some aggressive analyst target hikes over the weekend.
But it was a classic bull trap. It hit that peak and immediately reversed hard, bleeding out over $29 from the highs to close near $629.10.
WDC is the perfect case study of what we discussed earlier regarding institutional supply. The smart money wasn't chasing the breakout. They were waiting at the top.
They used it as an exit.
Exactly. The moment WDC hit that all-time high, retail momentum ran directly into institutional iceberg orders. The big desks used that buying frenzy as exit liquidity, crushing the advance and trapping everyone who bought the morning gap.
Conversely, you look at a name like MicroStrategy, ticker MSTR. It had what the analytics call a power inflow reversal.
Yeah, completely different chart.
It dipped down 4% in the morning session, testing $131.47. But instead of bleeding out like WDC, algorithmic VWAP buyers stepped in. Institutions aggressively defended that downside level, triggering a massive buy alert, and MSTR reversed to close up over 6% at $131.90.
So the big money was surgical today. Sell the cyclical peaks, defend the intraday dips on specific crypto-adjacent and tech names.
But all of this individual stock action is really a sideshow compared to the absolute elephant in the room.
Wow.
The real structural event of the week isn't the Fed, and it isn't WTI crude.
Yeah.
It's SpaceX, ticker SPCX.
Oh, man, yeah.
The largest IPO in financial history just executed last week. Today, it traded completely unhinged, rocketing up 18.6% to close near $160.95. We are now looking at an asset that just crossed a staggering $2.1 trillion valuation.
Massive.
And tomorrow morning, Tuesday, June 16th, SpaceX officially gets its options chain listed for the very first time.
Which, from a market mechanics perspective, listing options on a newly minted $2 trillion company is basically lighting a match inside a powder keg.
Walk us through the actual plumbing of why this is so dangerous. We have a mega cap valuation, but the actual public float, the shares available to trade, is tiny right now.
Right. So tomorrow morning, you're going to see a tidal wave of retail and institutional demand buying SpaceX call options to chase this 18% momentum. Everyone wants in.
Naturally.
But the market makers selling those call options, they don't just take the other side of the bet naked. They have to hedge their risk.
Right.
When they sell you a call, they take on short delta exposure. To neutralize that, they are mechanically forced to go into the open market and buy actual shares of SpaceX.
So the dealers are buying the underlying stock simply to hedge the derivatives they just sold.
Exactly. That is delta hedging. But here's where the low float dynamic creates a structural nightmare. Because there is such a limited supply of actual SpaceX shares available, when these massive market makers flood the tape with buy orders to hedge their books.
They immediately drive the stock price violently higher.
Yes.
And as the stock price goes higher, the math on those call options changes, right? The delta increases.
Yes, the options get deeper in the money. And because the delta increases, the market makers are suddenly underhedged again.
So they have to buy more.
They have to go back into the open market and buy even more stock just to catch up. This is a gamma squeeze.
Oh.
You have a recursive feedback loop where the options tail is violently wagging the equity dog. The strategy notes suggest going long on SpaceX volatility into tomorrow's open looking at front-month straddles or strangles, because as dealers build these hedging books from scratch, the intraday price swings are going to be historic.
It is the ultimate collision of market plumbing and momentum. Which brings us to the map for tomorrow, because you are going to need concrete levels to navigate this chaos.
Always need levels.
For the SPX, the data shows a massive gamma wall sitting directly overhead at the 7,600 level. And for anyone trading the index, this isn't just a psychological line on a chart. There is physical options math anchoring the market there.
Yeah, a gamma wall represents the highest concentration of dealer positioning. Options dealers are heavily short call options at the 7,600 strike.
Okay.
So as the market rallies towards 7,600, those dealers have to buy futures to hedge. But the moment the index actually touches 7,600, their gamma exposure flips.
Ah, so what happens then?
If we push above it, they're mechanically forced to aggressively sell futures to stay delta neutral. So that 7,600 level acts as a heavy mechanical ceiling. The dealers are literally selling into the rally to suppress the breakout and protect their own books.
So the market can't cleanly break 7,600 unless structural, real money buyers step in with enough billions to completely overwhelm the market maker's algorithmic selling.
That's exactly.
And based on today's low volume, that real money is currently sitting in cash.
Which means we are highly likely to reject off that level. And if we look downward, the immediate structural support level that the bulls have to defend is 7,500.
The SPX has to hold that line intraday, because if 7,500 fails, the internal reports flag the next level down as the trapdoor.
Because today's massive headline-driven gap up left a massive hole in the daily chart.
Markets abhor a vacuum.
They do. If support at 7,500 breaks, there's no structural liquidity directly beneath it. You can expect a very fast, very violent flush down to fill today's gap.
So that trapdoor drops the index all the way down to the 7,430 to 7,450 zone, which was Friday's closing range.
Right. And the absolute line in the sand, the ultimate defense for the medium-term bull market, sits down at 7,300.
But we also have to respect the statistical probabilities of Monday's momentum carrying over. Historical quantitative models outlined in the research show that when the SPX closes in the top quartile of its range on a massive macro breakout day like we just saw,
there is a 61% chance of morning follow-through the next day.
So we very well could see a push toward that 7,600 wall in the first 90 minutes of trading tomorrow.
It's very possible. But with the FOMC meeting officially kicking off, that early bullish momentum is highly likely to face a brick wall of institutional supply by lunchtime.
Yeah.
The PM session is going to devolve into choppy, range-bound consolidation as desks aggressively de-risk, flatten their books, and just wait for the Fed.
Which brings us to the final critical macro question that needs to dictate your risk management for the rest of the week. We just spent 20 minutes breaking down how a $2.1 trillion company's price discovery tomorrow is going to be entirely dictated by market makers scrambling to hedge options on a low float.
Right.
We saw the broader indices rally big today on paper-thin volume just because systematic funds were forced to buy when the VIX collapsed.
It really forces you to look at the market and ask, are we actually trading the fundamental value of companies anymore?
Seriously.
Or has the entire stock market simply become a derivative of the options market?
Exactly. If the tail is now permanently wagging the dog, and this much upside volatility was generated purely by mechanical hedging and short covering in a low liquidity vacuum, what happens to the very fabric of this market structure when the real heavy institutional volume finally steps back into the arena on Wednesday?
That's the million-dollar question.
If light volume just pushed us to all-time highs, what will heavy volume do if Chairman Warsh decides it's time to aggressively hike the rent?
That is the exact setup for a structural key reversal. The fragility is hidden right there in the green ink.
It is a chilling reality check, and exactly why you cannot trade the headline without understanding the plumbing underneath it. Thank you for sending over this incredible stack of institutional order flow data and for joining us on this deep dive. Manage your risk, respect that 7,600 gamma wall tomorrow morning, and we will see you at the next closing bell.